Hi guys, today we will put in an example on charts of color options so that I can show you how it really works. And I would recommend you whenever you trade like color option, then even check it out daily on the chart level. Never like sleep on it. Check it out. Always check it pulse if it is running in your favor or against you. Now, as we discussed, that I am showing you my strategy that shows how to check it each and every day and work it out from it. How my strategy helps you to understand where to place this strategy, how to place this strategy, when to place this strategy. All these things are really important. The most important of all. Because if you won't know how the game works, you would never be able to make money. The number one thing. Now on Udemy or on any other like website, you will see people teaching different strategies. They will tell you put a put option at this rate, put a call option at this rate, and if you're lucky, then the price will stay in between and you will make money. If you're not lucky, then this will happen and this will happen. Right. But how to understand or how to place it correctly is an art that is not available to everyone. And that's the major thing, the difference between you, the retail investor, and the hedge fund or high net worth client. The difference is this, that they know that they will put a collar option strategy at this time, not before that, not after that. Whereas you as an investor, like 99% don't even know that collar strategy exists. Even the 1% who knows that collar strategy exists cannot implement that strategy because they don't know when to implement it. They know how to implement it, that is to put in a put collar and put in a call collar, a call option, and the collar option strategy is placed. But the real point is at what time to put in, which rates to put in, how to put in. Yes, you can place it without my strategy, but then you will have a risk associated with it. You might make 5 out of 10 trades good, but the other 5 trades will be bad. And at the end of the day, you will be either in like break even position or in losses, huge losses. The point is understanding it. Now, I will be teaching you this thing right here, right in this lecture. But my advice to you is, before jumping into the market, test it yourself on old charts and then jump on it so that you have polished your skill, because skill is really important. If you trade in the market and you don't have a polished skill, you will lose money. If you have read the book Art of War, although it's not related to options, but it gives you a real help. It tells you if you know yourself and you doesn't know the enemy, then you might win one battle, but you will never win all the battles. It again tells you if you know the enemy but you don't know yourself, then you might win 1 or 2 battles because you know the enemy, but you will always lose all the other battles because you will not be fighting with the same enemy again and again. The same thing applies in the market. And the market is like a battlefield. There is one person is you, and there is another person who is standing like on the other side of the trade. If you have bought it, someone has sold it. So it's a war between you and that person. You might not know him, but it is a war. So you need to put in these strategies to cover all your ends so that you always make profitable trades. Just think on it. How do these hedge funds make profit year on year? Just read Fortune magazine, and you'll find that these hedge funds have made profit since last 15 years, 20 years, and even when they have lost it in like times of extreme volatility like 2008 crisis. They have only lost in the crisis year, and other than that they have always made money. How the hell do they make money each and every year? You as a retail investor, you don't have this much like great luck. You lose money, you gain money. But they always end up in profit. How? Due to these strategies. They implement these strategies and they book in their profits. They know that their risk is reduced. Whereas you, the retail investor, always plays without risk. And when I say without risk, I mean to say that you are always playing against yourself. So now just look at it. The price is going straight forward. Now, when do you apply this collar option strategy? When you have risk, when you have a good profit, or you have bought it and you don't want it to go down. Now, if you look at it, I have implemented the Bollinger Band as we discussed earlier. Now, I would suggest you to let this price move forward. Okay, it's going straight. We won't implement the collar strategy now. If you're buying it, then you can implement the call option above the Bollinger Band and the put option below the Bollinger Band. Because as we discussed earlier, if it moves at a certain end, it will go lower or higher. But if you would have bought it right here somewhere, then you are in break-even point. And buying it right now won't be like a good strategy because you won't be making money. So I would suggest you to wait for it. Wait for it to come to you and then buy. Now as you can see, it rose on the top. So if you have bought it right here somewhere, let's presume you have bought it at 34.80 and the price moved up. Brilliant. Let it go up. It goes up, 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 then comes down, comes down, comes down, comes down. If you look at the top Bollinger Band, it is at 38.78, 38.82, 38.81. This is the first time it has gone a bit lower. Second day, it again goes up. So you cannot implement the strategy right here. You would wait. Now again, it went from 95 to 93. That is 38.95, 38.93. So it's a 1 day down period. Again it went up, up, down, down. This is the second day down. Right? Now I would suggest you to place the trade. You have bought it here somewhere at, let's say, 34.91. If you can see, this is open, high, low, close. This is the top Bollinger Band, this is the bottom Bollinger Band number, and this is the middle red line number. Now you can see it has contracted. Now once the top Bollinger Band contracts for 2 days in a row, then you can implement your strategy. That is, you put in a call option above the Bollinger Band. Always remember, above the Bollinger Band. Now you might not find like the call option at 38.90. Sorry, 39.06. So you need to buy it at 39. Because if you look at the options, usually they are at round numbers, not 38.09. And the same way, for the put option, you will implement it on the lower side, below the Bollinger Band. Now I am covering it in red, the lower line, and in green, the upper line. The reason being, if it stays between these two lines, we get to keep the net premium. That is, we are paying premium on this call option and we are getting premium. Sorry, we are paying premium on this red put option, and we are getting premium on this green call option. So if we end up in profit, it's called a net credit premium transaction. So basically, I would suggest you to put in a net credit premium transaction and not a less net loss transaction, or a costless caller, that is no profit no loss. But if you look at our red line, it's risky, it's near our price. So even if we put it here, it will help us to make no profit no loss trade. Now I would suggest you to not implement it here, implement it at 36. Why? Because in options, if you look at it, they are basically round numbers. So either you can implement it at 36 or 35.50. It's up to you to choose a price in between these two prices. But don't go beyond that, because you need to stay below this Bollinger Band. Now you might be considering, okay, I'm saying below this Bollinger Band, but this price is higher. But this is through my experience. How? Just look at it the next day. The Bollinger Band rises up. So it's basically contracting. So the price Bollinger Band will continue to go up, up, up and contract. That's the point. That's why I will recommend you to put it near the Bollinger Band, but not really upside, because this red line, the Bollinger Band will never reach this red line. It will always be a little bit like gap. So always try to be near this line. Because the options don't give you a 38.09 stuff, so you need to pick in a round number. So the round number should be near this line, this lower Bollinger Band. Now if you look at it, we have traded the caller option right here. Right here. This is the first day. And let's presume we have traded it 30 days from now. Or let's take the weekly options. We have used it for 1 week. So 1, 2, 3, 4, 5. No problem. 1 week passed. You made no loss, no income. The price stayed in between. You get to keep the net credit and the shares as well. You placed another trade. Again, a weekly expiring contract. 1, 2, 3, 4, 5. On the 5th day, it broke our line. We squared it. We booked in our shares through this put option. As this put option person needs to purchase our stock as and when we need. So on the expiry, we will say, okay, buy it from us. He will buy it from us, and boom, we get out of the stock without any risk. And we were paid for this 5 days, the first week, and for the next week. So we got 2 paid options caller transactions, 2 weeks in a row. And in the second week, okay, we said square it out. So those premium that we earned on those 2 weeks helped us. Whereas it helped us in booking our stock if it goes lower. Now, if you have learned from the first chapter on Bollinger Band, it told you if the price goes lower than this Bollinger Band lower line, it continues to go down. If it goes higher right here, it continues to go up. And then it went straight. The point is, you didn't took the risk of going down. Now let's take a look what happens next. It goes down, down, then comes back up, 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 then again straight. My point of view is, the game is simple. As simple as anything can be. What I am trying to say is, when you're trading, you have to have a understanding of what is happening in the stock. Now, Bollinger Band gives you that understanding. Now, basically, on a caller option, if it is a net premium transaction, then you need the option to go straight. Don't fall, don't go up. But you are not God. You cannot understand that if it will go down or up in a really short term. So, this strategy of mine, this Bollinger Band will help you understand that. If you look at it, it's remained straight. See, it continued to contract. So, it gave you 2 weeks to make money. Even if you would have bought it at 30 days expiry, then even it would have come back up. And this would have been 1, 2, 3, 4, 5, third week, 1, 2, 3, and 4, 5. This is the 1 month expiry date. Now, if it would have ended here, you would have used this call option and sold your share here in profit. So, even if you take the 1 month expiry contract, options contract, then even at this option you won't use it right here. You would wait for the expiry, because on expiry you can simply claim this put options contract and sell it right here on this rate without any risk. If you remember, we bought it at $34.91, so we are selling it at 36. That's still $1.10 profit, approximately 4 or 5%. That's good, right? And the best thing is, when we traded here, we didn't know it will go up or down. We were still thinking it will go up or down. But as the Bollinger Band was contracting, so we used it to our advantage, so that our risk is not going up and our risk is limited. We put in 2 lines, 2 options contract that acted as floor. This line was floor, this line was cap. If it even broke, let's presume we have a 1 month expiry contract, then even we would have waited for the 1 month expiry contract to take decision on put or call option, because we can sell it on both. If the price went up, we would have used this. If it went low, you would have used this. So the expiry date is up to you. If you would have used weekly options contract that we discussed just now, then this would have been the second week. And on expiry, you would have used this this put option and squared your shares right here on this red candle. Not at the close. The close of red candle, this is the close number, is 35.67. But we closed it at 36 because our put option is at 36. Same way, if we would have put in a 1 month expiry contract, then it would have gone up and we would have squared it on our cap rate of 39 without any problem. So the problem is not in choosing weekly or a 30 days expiry period. The point is in choosing whichever options contract you like. Try it to be a net credit transaction. That is, you get to keep a premium. Reason? Because your risks are reduced. And through Bollinger Band, it will be reduced. Once it went up, you know it's going up, and this is your max profit. Boom. If it went lower, then you have a risk it can go lower. So you would have waited till the expiry date, and on expiry date you would have squared it right here. If it would have come back up, let's presume, and the expiry date was on this date, then you would have get to keep the net credit premium through both these transactions, and you would have put in another options contract. Maybe again at these rates, maybe not at these rates. The next options contract would have been lower or at the same rate. You can do anything you like. The point is, my strategy helps you to understand what is happening. Now if you look at it, we made it at 36. Yeah, if you look at it, we made it right here. My strategy told you that Bollinger Band is contracting, so you need to wait for it. You waited. Once it went down, you could have squared it here if the expiry date was on this date. If it was not, then even you would have waited for it to come back. As simple as this. So the point is that my strategy is designed to help you know when to do it. Now I told you to do it on contracting of Bollinger Band, but let me show you another side. The other side is you can place it on any day you like, but try to place it once it has risen something for you, once it has given you some profit. You have to have something in your pocket. If you have bought it at $100 and it's trading at 102, then putting in this collar option is not highly suitable. You should put it if you have some profit. That's why if you would have bought it here at 34.91 and it is giving you 4-5% profit, then you could have put in the collar option strategy right here above the Bollinger Band top band, the call option, and below the Bollinger Band lower this band line, the put option. So this will help you understand which strike price to select, because if you select it, let's presume this rate 37, then it will suddenly come down, come up, come down, and will give you a scare that okay, at the end of 30 days you might have to square it right here. But you can do that as well, because you have to wait till the 30th day expiry, and on 30th day if it is above that, you get a huge profit. So the lower put option that we are discussing needs to put in either at the max loss you are willing to take, number 1, or below the Bollinger Band lower line, number 2. These are the two things that you need to keep in mind. Number 1, at the max loss you are willing to take. Example, this line. Number 2, below the Bollinger Band lower line. And that's it. The above line, I would recommend you to always be above the Bollinger Band. Reason, because it's the max profit. So if the price goes beyond that, you make good money. Or you can even put it further out. Why? Because what's the problem? If it stays between the band, the price stays between the band, you get to keep net premium. If it goes beyond the this line, this is the max profit. So the max profit can be adjusted as much you want, but it should be always higher than the Bollinger Band, never lower. You don't want to stop your profits from coming. This is a really important thing that I just told you, and do write it down and put it right in front of you when you are trading, so that you know when to put in the collar option. It's really important. It's really, really important.